Silver slammed down to $71, and then ripped 17% higher in the same stretch of hours like someone flipped a switch. $10 trillion in market value evaporated in just 3 days. Gold, supposed to be the calmest asset in the room, started trading like it was scared of its own shadow. And Bitcoin? It didn't just wobble. It crossed the exact danger line that signals contagion, days before the metals got hit. So let's be brutally clear in the first 15 seconds. This was not a normal dip. This was forced selling, followed by a violent rebound that only happens when somebody important is trapped and somebody else is taking advantage. You're watching my channel, and if you want the cleanest breakdown of what just happened, what it likely means, and what the next signal is, subscribe right now, because the next move in this story won't give you time to think. Quick question before we go deeper. Do you think that $71 was the real low? Or do you think that bounce was a trap designed to pull buyers in before the next wave? And second, are you watching this from Pakistan, the US, the UK, or somewhere else? Drop it in the comments. I want to know who's actually awake for this moment. Now let's unpack the sequence, because the sequence is the whole game. Metals opened with a kind of violence you don't see unless leverage is being ripped out of the system. Silver didn't slide. It fell through levels like they weren't there. $75 didn't matter. $73 didn't matter. And then $71 printed, fast, like the market needed that price, not because it was fair, but because it was necessary. Then the market did something that makes professionals sit up straight. It didn't drift. It didn't base. It didn't slowly recover confidence. It snapped back. $71 to $83 is not a normal recovery. That's not buyers returning. That's not value investors stepping in. That's a squeeze. That's shorts grabbing the steering wheel and yanking it back because the car was about to go off the cliff. And while everyone stared at silver, gold was bleeding too, down hard, then bouncing, but not with the same fury. Gold dropped, printed a low near the low $3,200, then reclaimed a chunk. Respectable bounce. But silver's bounce was a punch to the face. That difference matters, because it tells you the selling and the rebound were not purely macro. It was positioning. It was mechanics. It was margin. And the moment you accept that, you stop asking, why did silver fall? And you start asking the only question that matters. Who needed cash so badly that they sold the best assets first? Because that's the rule in real panic. When big money is forced to sell, it doesn't sell what it hates. It sells what it can. It sells what's liquid. It sells what has buyers. It sells what clears instantly. That's why in stress events you'll see the weirdest thing. The safe stuff drops first. Not because it isn't safe, because it's usable as emergency cash. So let's talk about the number that should scare you more than the $71 print. $10 trillion. In 72 hours, the combined valuation tied to precious metals got hammered. Gold alone shedding an enormous chunk of value in a tiny window is not a headline. It's a signal that liquidity is being demanded at scale. Now here's the part where people get fooled. They'll say, well, maybe gold dropped because the world got safer. No. What changed in 3 days that would justify gold trading like a collapsing meme stock? Did government suddenly solve debt? No. Did central banks suddenly dump reserves? No. Did fiscal discipline arrive like a miracle? No. In fact, the backdrop still looks like a pressure cooker, and yet the price acted like the pressure disappeared. That mismatch is the crack in the wall, and once you see it, you can't unsee it. Because modern gold doesn't trade like ancient gold. Modern gold trades as two different markets wearing the same name. There's the physical market, real bars, real vaults, real delivery, real constraints. And there's the paper market, contracts, synthetic exposure, leveraged positions, and a giant pool of gold that exists only as a promise. Most of the time, the two move together closely enough that nobody questions it. But during events like this, the spread talks. And the spread was screaming. While the West was throwing paper at the market to raise cash, the East wasn't acting like it believed the story. Physical pricing didn't collapse the same way. Premiums told you there was still a strong bid underneath the surface, even while screens in New York looked like a disaster movie. This is what market dislocation looks like. One side says, sell everything, we need dollars. The other side says, thank you for the discount, we'll take the metal. And when that happens, the next phase is predictable. Not because the future is easy, but because the mechanics are. Paper can fall fast. Physical doesn't panic at the same speed. Eventually, the two are forced back together. Either paper rises toward physical reality, or physical is forced down by a deeper systemic unwind. That's the fork in the road. And silver's 17% rip is telling you the market is already fighting over which path it's taking. Now, you need to know what the early warning siren was, because it didn't come from gold. It came from Bitcoin. And I know some people hate hearing that. They want their markets neat and separate. They want tidy categories. Crypto here, metals there, stocks there. But the modern system doesn't care about your categories. Leverage connects everything. When leverage cracks, the sequence begins. Crypto trades 24/7. No closing bell, no pause, no weekend protection. So when the system starts to wobble, crypto often moves first because it has the most continuous price discovery. That's why Bitcoin's behavior going into this event mattered. A specific threshold was the line between risk still alive and risk is breaking. And when Bitcoin slipped below that line and couldn't reclaim it, the clock started. Then, right on cue, the liquidation wave hit the metals. That doesn't mean Bitcoin controls gold. It means Bitcoin is the canary that suffocates first when the air gets thin. So what happened when the metals got smashed? Funds got margin called. And margin calls do not care about your long-term thesis. They don't care that you bought gold to protect against debt. They don't care that silver has structural industrial demand. A margin call only says one thing: bring cash, now. So what do leverage players do? They sell what's liquid. They sell what's still green. They sell what has bids. They sell gold. They sell silver. And that's why you saw the insanity: safe haven assets falling during uncertainty. Not because they lost their role, because they became the emergency exit. Now here's where the story gets dangerous. Because after a forced liquidation flush, the bounce can mean two totally different things. It can mean the bottom is in, or it can mean the trap is set. And the trap is always the same. First, the market terrifies everyone. It prints a low so ugly it feels like the world is ending. Then it rips higher hard enough to create hope. People who sold feel regret. People who didn't buy feel fear of missing out. Then buyers rush in late, chasing the rebound. And that's when the market rolls over again, because the real unwind wasn't finished. That's the bull trap pattern. So which one are we in right now? Here's how you separate reality from emotion. You don't guess, you measure. If this was true capitulation, you should see real confirmation. You should see buyers defend key levels, not just spike prices. You should see follow-through, not just a one-day miracle. You should see the market behave like it has found a floor. So what are the levels that matter? For silver, the first line is whether it can hold above the mid-70s without bleeding back into the low. If silver breaks back down and revisits $71 easily, that bounce was not strength. It was a release of pressure. For gold, the question is whether it can sustain above the level it reclaimed. Not touch it. Hold it through real trading sessions. For Bitcoin, the trigger is whether it can reclaim the risk-on threshold and stay above it, not for 5 minutes, but for days. If Bitcoin rejects hard and rolls back down, it often means stress is still leaking through the system. Now let's talk about the most important piece that people ignore because it's not flashy. Volume. A real bottom usually comes with ugly volume, panic volume, then strong accumulation volume. A fake bounce usually comes with relief volume, short covering, quick dip buyers, thin liquidity, then fading. So if you want the clean truth, watch how the market behaves when it's supposed to be boring again. Does it stabilize? Does it grind? Does it build? Or does it whip violently, up, down, up, like a patient with an irregular heartbeat? Because when gold moves like a meme stock, that's not just volatility, that's stress. And stress always comes from somewhere. Now let's zoom into the part that should make you feel uneasy, even if you're bullish. Because the story isn't just metals dipped and bounced. The story is that someone needed liquidity and chose gold and silver as the source. So ask yourself, if institutions are selling high-quality liquid assets for cash, what are they protecting? What position is so threatened that they'd rather dump gold than keep it? That's where the real cliffhanger lives, because it suggests that the problem may not be inside metals at all. Metals may simply be collateral being liquidated to cover something else breaking behind the curtain. And if that's true, then the next move is not about whether you believe in silver. It's about whether the financial system is about to demand more collateral, more cash, more liquidation. If the first wave took 10 trillion in 72 hours, what does the second wave look like if the underlying stress intensifies? That's why the question, low or trap, isn't a cute title. It's the decision point. Now let's talk tactics, because most people lose money not because they're wrong long-term, but because they play the short-term like a casino. If you are a long-term holder, someone who views metals as protection, this environment is where discipline matters more than prediction. That doesn't mean you blindly buy every candle. It means you respect the fact that timing is hard, and you use a strategy that doesn't require perfection. That's why a structured approach, buying in slices, with rules, beats emotional impulse. Because the market is designed to hijack your nervous system. It wants you terrified at the lows. It wants you euphoric on the bounce. It wants you to do the exact opposite of what helps you. Now, if you're a trader, you don't get the luxury of eventually. You need a plan that survives both scenarios. So here's what a professional mindset looks like. If it's a real bottom, you don't chase the first spike. You wait for confirmation, then you enter with defined risk. If it's a trap, you don't argue with the chart. You preserve capital and wait for the market to show its hand. Either way, you do not bet your entire future on one candle, because candles like this are where accounts die. Now let's address the narrative that will flood your feed right after a bounce like this. They'll say, see, crisis over. They'll say, that was the bottom. They'll say, the smart money bought. Maybe. Or maybe the smart money used the bounce to unload more quietly. Because here's the thing. The first panic wave is loud. The second wave is clever. After the flush, institutions don't dump in one blast. They distribute into strength. They sell into rallies. They let retail chase, then they feed the market supply. So if you want to know whether smart money is buying or selling, don't listen to anyone's confidence. Watch the behavior at key levels. If price rises and keeps rising with strength, that's accumulation. If price rises and then starts stalling, failing, breaking support again, that's distribution. And silver's violent bounce makes this harder, because violent bounces create the illusion of certainty. But certainty is exactly what the market uses against you. Now here's the one indicator that keeps everything honest: the physical market. If paper prices plunge but physical premiums remain elevated, it tells you physical holders aren't dumping. If paper bounces but premiums stay high, it tells you physical demand is still there. If paper collapses and premiums collapse too, it tells you fear has reached physical holders, and that is when things get darker. So watch the spread between the screen and the street, because the screen can be manipulated by liquidity. The street is governed by inventory, and inventory doesn't lie. Now I'm going to give you the most uncomfortable thought in this entire story. What if gold didn't fall because gold is weak? What if gold fell because the system is hungry? In every major unwind, at some point, the system starts eating its own best collateral. It sells the good stuff to cover the bad stuff. And when the good collateral starts moving violently, it can mean the bad collateral is reaching the breaking point. That's why this is not just a metals video. This is a stress test video, because the metals move is a symptom. The disease is leverage, and leverage always demands payment. Now let's get to the final question you actually came here for. Is the bounce back real, or is it a trap? Here's the clean answer. We'll know by whether the market can hold the reclaimed ground when pressure returns. Because pressure always returns. The first flush is emotional. The retest is mechanical. Markets don't just bounce and go straight up after an event like this unless something fundamental changed. And nothing fundamental changed. Debt didn't disappear. Deficits didn't disappear. Geopolitical risk didn't disappear. So the market has to prove the bounce is real by surviving the next wave of reality. That's why the next few sessions matter more than the first spike. Watch silver's behavior around its reclaimed support. Watch gold's ability to stay steady instead of swinging wildly. Watch Bitcoin's ability to reclaim and hold its risk threshold. And most importantly, watch whether the system demands liquidity again. Because if you see a second forced liquidation wave, you'll know the first bounce was just a pause. But if you see stabilization, shrinking volatility, and steady demand, you'll know the flush may have done its job. Either way, don't let the market make you stupid. Don't let one candle convince you you're safe. Don't let one bounce convince you you're late. Play what you see, not what you hope. And remember this, 10 trillion didn't vanish. It moved from forced sellers to patient buyers. It moved from panic to planning. It moved from leverage to discipline. So here's my last cliffhanger for you, and it's the real one. If institutions were willing to sell gold like a penny stock just to raise cash, what happens when they run out of good assets to sell? Because when that moment arrives, they don't sell gold. They sell the thing they promised you was safe. And that's when the next signal hits. Hard. So stay sharp, watch the levels, and if you want the next breakdown the moment the next signal flashes, subscribe to this channel right now. And answer me in the comments. Do you think this was capitulation? Or do you think the real liquidation hasn't even started yet?